All right, well, good evening, folks. Thanks for your attendance here at our usual fortnightly webinar, and today we're going to talk about trading, and we've got a couple of fairly specific areas we want to cover. We've had requests from members to just go over the entries, stops, reversals, and targets for the Danielcode trade signals. We've had another request to look at the phenomenon of markets using the Danielcode reversal retracement signals. They're the red lines and the black line that you're familiar with, and how markets can often use those from the wrong side. So we'll get right to it, and the first thing that we're going to look at is just a refresher for our folks who are new here. The signals that I'm talking about are available. They come in the Danielcode website at www.thedanielcode.com. They're posted every day, usually about 2.5 to 3 hours after the US markets close, and they come to you in this form here that you have in the Danielcode website. You have this list of access tabs. Mine have got a few more than yours have. You won't see all of these, but you just click on the TO3 Plus tab there, and that will bring up a page like this. Now, this starts by telling you what are going to be the trade signals for the day. It tells you whether they're a TO3 signal or a blue line signal, a daily, or an inside bar. And there are reasons why it's differentiating those signals, because the TO3 signals are valid for 2 days, including the day of posting. The blue line signals are valid for 3 days, including the day of posting, and the inside bars have a very special entry technique. So that's why we show them to you separately like that. The next page just highlights to you the different types of trades that we create. They're basically classified as reversals, continuations, and threes. Reversals, by definition, they're the TO3 and the blue line trades are always against the trend, so they require a more vigorous application of stop-loss management. The continuation signals are those with the trend. We have a laxer, looser method of stop loss on those trades, and the threes are something in between. They're a hybrid. So we'll show you all of those. This is where the signals then go. They go into this trade program, and it's under this tab up here that says trade program, and every day these signals will appear. If these signals have not been elected on a previous day and they are still valid, they will be carried forward automatically, so you don't need to worry about that. And this trade program shows you what the signals are, what markets we're going to execute these signals in. So, for example, down here, this is the German DAX, and if you didn't know it, it's telling you that the signal, the market that you'll execute the orders in is GX057, which is the code for the DAX contract. It tells you whether it's a buy or sell. It tells you exactly where to enter. It tells you exactly where to put your first stop, and it tells you the first target. Now you'll see in these list of types of trades here, R for reversal, C for continuations, and threes are an intermediate trade, somewhere between a reversal and a continuation. We're not going to talk about correlations today, other than to tell you that they are all in there. The trade program has done that for you. And once you enter the amount of your account and the risk you want to take, it will tell you, it will give you a recommendation of how many contracts you can take in each of those markets to stay within that risk parameter. If you're only trading Forex, you'll just take the Forex signals. If you're only trading futures, you'll just take the futures signals. And some of you I know just trade particular markets. A lot of you will just trade S&Ps and gold, maybe oil, maybe bonds. So you just type into the box there the number of contracts you want to take, and you press the recalculate button, and it will then recalculate that material and let you know how many contracts you can take without without breaching your risk parameters. So these are the rules for the contracts. These are in the Danielcode website. They're underneath the trade program that we just saw, and you can see there that we have specific rules, specific stop-loss strategies, and specific exit protocols for all of these trades. Now, one of the things I want to talk to you about is that you should view these only as a starting point. I've designed these signals to be as safe as possible. That's where we come from, with maximum safety, not with the view of gaining maximum returns. The idea has always been that if you are newer to trading, or you don't have a lot of confidence in making your own decisions, which none of us do in the early stage of our trading, so I mean, don't feel bad about that. That's very much the norm. You can follow the Danielcode trade signals using exactly the entries and protocols that we set out there, and you will do very well. More importantly, you will be safe. And that's the main thing in trading. So that's why we have those notes and entries there. Now, just to bear in mind, TO3 signals are reversals. That is their nature. You're looking at one there now, and they require a more aggressive stop-loss protocol, because the most common counter trend in a trending market is 1 day. So when we get a TO3 or a blue line signal, they're reversal signals. Probabilities are that we can be trading a counter trend, so we need to be a little bit more aggressive on our stops. The way we do the stops on these is set out under the Danielcode trade program. We have a first target that's fairly modest, and when we reach that first target, we take off half the position and we move the stop to break even, so we've got rid of our risk very early in the trade. We always get comments about this stage saying, oh, the risk reward's not good. Well, you have to understand the total trade. The risk reward, the place you'll have your stop to the stage you get to the first target, is not good. It's quite small, in fact, and it's designed to be that way. But at that point, we're doing two things. Firstly, we're taking off half our position to make sure we've got some small profit locked in, and then we're moving our stop loss to break even. A lot of these trades will come back and stop you out at that point, but enough of them go on to make that program profitable. So it's a very, very safe way of trading, which is the primary thing in my mind when developing these protocols for you. These are the 3 threes. We just call them the threes, and they are somewhere between the reversal signals and the continuation signals. And with them you enter in the normal way. This is a semi-momentum type of program, so you enter at the high or low of the previous bar, unless it's an inside bar where we have specific entry positions. And all of these are created for you. You don't have to do the math. They're sitting in the trade program. You just have to read the number from there. We leave our stop above or below the setup bar. That's the bar before we enter. We don't move the stop on these trades until we get the first profitable close, and we exit at that stage. So that's the threes trade. Here's an example of the continuation trades. In trending markets, these continuation signals just go on and on and on and on. This happens to be the E-mini, which had long periods of trending this year and last year even more so. So you can see that the continuation signals are just one after the other, and we have a looser protocol for the stop loss on those. What we do with those is we use the 533, the fast stochastic, to manage the stop loss, and we use a 2-bar trailing stop until the stochastic gets overbought or oversold, as the case may be, at which stage we tighten up to a 1-bar trailing stop, and we then invite the market to stop us out. In some cases, up here you'll see we were long in here, and then we got a sell signal. It's vital that you're able to take the reversal signals when we get them. You didn't want it. I mean, it wouldn't have mattered if you'd sat long all the way through this move, but you're better to make sure that you've recognized that there is a sell signal that's valid, and if it is elected, your stop is under this bar here. You need to either be flat or short. if you're a futures trader and you're confident in this stuff, you will of course be short. This is the chart of the Euro USD, and this is one of the questions that was on the forum. We had some questions on the forum asked by members about specific things they want us to deal with, which I'm going to do today. And just have a look at that. I've got a better version of that. I can show you more simply and more accurately when we go to the charts, which we'll do shortly. But these retracements here, these are the Danielcode retracements, and they all come from a tool, the Danielcode retracement tool, which is available to all Danielcode members in Trade Navigator. And for this case, I've clicked on the top of this high down to the bottom of this low, and these retracements relate to this swing from this high to this low. So they are retracements going down, and we would expect the market to find and acknowledge the points on these numbers, and it does. And there's one, I've marked them with a red diamond, and there's two, and that's about it. Now, remember, these are the retracements for the up to down swing. They should be only giving support to the market coming down, but these are all fractals. All the Danielcode is fractal based, which is one of the biggest secrets to the market, recognizing that. And so they are important numbers while the market is within that swing. And you can see what it's done since it made that low there. It rallied up. The blue ones show you where it has recognized these Danielcode retracements from what I would call the wrong side. Here's the high to low. These are the retracements, so it should stop there. That's fine. It rallied up. It tested this number from the underneath. It then went down. It stopped there, which is what we'd expect. It then went down. There's a couple of blue lines down here. I'm going to show you a fuller version of this. But it then rallied up, and it tested the Danielcode retracement from the wrong side, from underneath. And it did it again there, and it did it again there. And in all of these blue diamonds, you can see that the market is using and testing these Danielcode numbers, which no longer relate to the operating swing. The operating swing has moved. This is the low now, and from low to high would give you your operating swing. And if you put your Danielcode retracement tool on there, drag it to the high, you'll get a completely different set of numbers. But you can just see how this market has just continued to run on these original Danielcode retracements, and markets do this all the time. I think Nick and Fred asked for this, and it's because these are fractals. They are divisions of the range that the market recognizes. So that's very common behavior in markets, and it's very interesting, and we're going to see more of it. I just wanted to give you your contact details very briefly for folks who are interested in getting access to the Danielcode trade signals. If you're not members, please contact Dan or Jerry. You can call them on 312-588-0016. For those of you who are existing members and would like to upgrade or make other amendments to your subscription, please contact Terry at support. He's our tech guy. Most of you know him. He does a great job of keeping the website running and handling a lot of problems that you folks have. So he's a very nice guy. He lives up in Canada, so I guess things are fairly cold up there today, Terry. Terry's number is, it's a US number, that's the US code, 260-918-0155, and that's how you can contact Terry. We'll leave these numbers up just for a moment. You can just write them down. If you're not already a Danielcode member, you'll need to talk to Dan or Jerry about access to these trade signals or any other part of the Danielcode, or arranging a trial, or whatever you will. I've had a number of people write to me and ask a whole list of questions about metrics and back testing and everything else. With all of our products, everything we do, we're always happy to give you a free trial. I have in the past shown testimonials and what have you, but It doesn't really matter if this has been great for someone else. The question is whether this is going to be great and or suitable for you. And the best way to do that is for you to take a free trial of any of my products, see how it goes, see how it suits you, and then if it does suit you, that's fine. Then you can subscribe. If you find it too hard or complex or time-consuming, then likely we have another product that will suit you. But talk to the guys if you're not a member, Dan or Jerry. If you're already a member, Terry, and they can arrange the free trials for you of whatever it is that you need. So let's just move away from here now, and we can go back to looking at charts. All right, so let's have a look at our Trade Navigator charts. For those of you folks who don't use this, this is the charting format that we use. It's very good. I've used it for, I suppose, close to 20 years now. It's fairly easy to use. If I can use it, anyone can, but more importantly, we find that it works particularly well with Forex. With futures contracts, you don't have the same problem. You can use any charting system because all the prices, the high lows, etc., are exactly the same, and all your charting systems will work just as well. In Forex, that's not the case because you don't have a central exchange. So each of the Forex engines will create its own charts, its own daily high-low. If you look at the data from PFG, FXCM, a few others, you'll find that it's different in many ways, and some of the differences are quite substantial. So as the Forex signals are created from Trade Navigator, if you want to trade Danielcode Forex, I strongly suggest that you have the Trade Navigator charts and software, and Terry and Dan and the guys can arrange a free trial of this also, so that is not a big deal. This is the chart we were looking at earlier on, Fred and Nick in particular, who are making the point that these Danielcode retracements seem to work both ways, and they do. So for this exercise, I've taken the swing from this high here up here, and this is the November 11th high in Euro USD. You can have a look at this yourselves, and we've taken it all the way down here to create the swing. In there, we now see a little more detail. This market has topped out here. It's starting to come down. It recognizes the Danielcode retracement number there. It then rallies up and tests from the underneath a Danielcode retracement number that it has already passed. It then comes down. It has recognition here for a couple of bars, couple of days. It then goes down. It breaks through the last red line, and it stops at a Danielcode blue line and reverses. Now, this is the interesting part. It runs straight back up to the old Danielcode retracements and tests it once. A few days down, up, and does it again, and then it does it again. So it's done it 3 times. It's tested that same 1313434 number. It then runs down. It finds the Danielcode blue line, and it creates a nice little key reversal bar there just to help us identify that's the low, guys. On its way up here, it gets 1, 2 recognitions of the retracements. Then it goes up to a blue line, comes back down. It's now testing the same retracement, 1, 2, 3, all the time, all the way through here. Until eventually it finds support at this number here. This 14031 incidentally is the 14.8% retracement. It's available on your Danielcode toolbar. That's in here. I'm going to show it to you in a minute. And then it goes up and exhausts itself at the blue line there. Don't forget, it's always wise to look at these charts not only as daily bar charts, but also on a close-only basis, which you achieve through this little zigzag tool up here. and you can see that its final recognition of the Danielcode blue line up there was very precise on a close-only basis. Let's go back. In your Trade Navigator suite, you'll have down the right-hand side here this tool, which is a little black hedgehog. His name is Dan. He's our mascot. And if you click on that, you'll be able to drag from a high to a low if you want the retracements, and it will create for you all of the Danielcode retracements, just as I've done over here. So let me just show you that again. We'll get rid of this. And we'll run the retracement from this high down to this low, and there you have your Danielcode retracements. Very easy. It's all set up for you. It's pre-configured. All you have to think about is that in here, there's the 29.7, which wasn't switched on, and there is one alternative, and the alternative is between the 59.3 and the 62.5, both of which are valid Danielcode numbers. But you can alter this, play around with it if you like, but it's already got the Danielcode numbers in it. So that's how that works, and that's pretty nice. So I hope, Fred and Nick, that's disposed of your idea. The answer is yes. These are fractals. They are recognized on both sides in many ways, and it's pretty interesting stuff. Let's move now to the S&P. This is the S&P chart. This, in fact, is the index. And Fred, I think you wanted to know how we achieved so much more in the rundown into this March 16th low here than the Danielcode trade signals on their own gave per se. So let's just run through here. Here is the market going up. It's going up its regression channel. It's now falling out of its regression channel. We didn't get any signals on that day. That was a holiday in America. It might have been Martin Luther King Day. We don't trade on those days or the day after, so I didn't post signals for that, but there was a fairly obvious sell signal there. Down it comes. We found this little buy signal here. We've gone 3 days down. We found the buy signal. We went up 2 days, and then we got a 3-3 sell. So actually, for a 3-3 sell, you're going to sell at the low of the setup bar. That's the previous bar. And the low of that is, you can see at the bottom of there, I think there's probably a tiny little gap. And I highlight that in green for you. If you don't have that on your charts, you should have. You can see on this bar here, there's a piece of green at the bottom of it. And at this chart here, there's a tiny little piece of green at the bottom of the chart. And that's to show you that there's a gap. Because when there's a gap of that nature, then the contract low or the market low of 13.20.55 in this case is not the true low, because you have to account for the overnight price action, which on this chart, which is the index, is shown as a gap. So the true low is the close of the previous day, which is 13.19.88. You'll see these gaps all the time. Here are some of them over here. Let's see, that's not quite what I wanted. Here we are. Look, there's a big gap there. There's a big gap there. There's a gap there, and there, and there, and there. Wherever you see these green tails, the chart is telling you that there is a gap there, and we need to use the true high and the true low for our entries, and not the charting high and charting low. So the rule is, if we look over here, where the low is higher than the previous day's close, then the true low is the previous day's close. Vice versa, coming down here, where the high is lower than the previous day's close, then the true high is the previous day's close. There's lots of webinars and videos about that on the website. So let's just run through here, Akshay in particular, so you can see how this is going to work. We have our we didn't take the sell signal coming down. We didn't trade that day. We got the buy signal there 2 days up. and then we've got our 3-3 signal. For this we enter 2 ticks below the previous day's bar. That's called our buffer. We use a 2-tick buffer for futures and a 5-tick buffer for Forex. And that's because in Forex markets, as I've said to you, that the prices don't come from a central exchange, and there can be variances between markets. So we allow that buffer to ensure that we're entering below a daily high or low. So we take this trade here, and we get in about here, somewhere about 13.19 or so. And then this is a 3-3. So the rule on a 3-3 is you exit at the first profitable close, which is obviously down here. So that was a nice trade. Then we get a little key reversal bar here, 1 day up. Now, let's have a look at this. The high of this bar is 1332.28. The high of this bar is 1332.09. So the high of this bar of March the 3rd is higher than the previous bar. So we can just put a little line on that to show us these 2 bars. This is the higher bar, and now we go down to our momentum indicator. This is a derivation of the CCI. This is a proprietary indicator that I give you with the Danielcode library, and once you've got that, you'll be able to see all these marvelous things. So let's have a look. There was our apparent high, and here's our next apparent high. But look what's actually happening with the stochastic. At the same time that the market has made a higher high there, the stochastic is making decidedly a lower high, and that's called divergence. And that's one of the things we look for as our setups to pull us into these TO3 and blue line trades. So divergence in the momentum indicator is very, very important. Anyway, because of that, we had a trade signal in the Dow. Now, remember, with these equities, they are also highly correlated, that if you get a signal in one, you can execute it in any other. So if you have a signal in the Dow, or the S&P, or the Russell, or the NASDAQ, or the German DAX, not quite as highly correlated. It runs about 92% correlation. These other markets run 98% correlation. You can execute them in any other one of the equity markets. So in this case, because I trade the S&P, I chose to execute it in the S&P. And the entry was way down here. This is an inside bar. For an inside bar, we take the trade at the high or low of the last bar that is not an inside bar. That's obviously this bar of March the 3rd. However, look at the gap at the bottom here. The low of this bar is not the true low. The true low is the close of the previous bar. It's a bit better than that on the futures chart, but I just want to make that point so you're aware of it. So we got short there. Now, this was a TO3 signal. You got short there. In here, it reached its first profitable first target. So you moved half you had to sit through 2 days of nasty inside days. But that's what happens in trading. And on this day, March the 10th, it reached its first target, at which stage you took off half your position and moved your stop to break even if you were following the Danielcode protocols. But let's have a look what's happening with these stochastics. Now, these are proprietary stochastics that have been built for the Danielcode, and the way what they have in common that is different is that they do not account for inside bars. Now, inside bars create almost all of the problems in reading stochastics. So by creating stochastics that ignore inside bars, we get a good deal closer to the truth of what the market wants us to understand. If we look at this here, we've got overbought stochastic running along here, overbought stochastic running along here. At this stage here, we start to lose momentum. The divergence comes in. There's the momentum indicator, thinks that's the high, and you'll see by the time it made its true high, it was lower. So we have got divergence there, and down it went. Now that's the top of the swing. So what happens with these stochastics? It's recorded at the top of the swing. The next thing it will do is create the low of the swing, and it goes down, and it does it here quite quickly, and that's our low of our minor swing. it then rallies up. So look where we are here. We've got our sell signal. It's already been elected. We've got our 2-day stalling, and we can now go down and look at our stochastics. Neither of them are oversold. So this is an ideal situation to hold on to this trade a bit longer. And you can see if you held this trade longer as mode is, that's what we were talking about, Fred. I showed this a slightly different way a fortnight ago. But if you're a confident trader rather, you could have used a 2-bar trailing stop all the way down here until this market got oversold, which was right here. You'll see up at the top in here, it'll tell you that the stochastic value had reached 20. On that bar there had reached 23. That's close enough. And back here it's even lower. It's down to 20. Once the stochastic gets overbought or oversold, by which we mean above 80 or below 20, and we're referring, of course, to the blue line, which is the faster of the two stochastics. That's called stochastic K. That's the one we're reading. Once you get down to the market being overbought or oversold, as happened on this bar here on March the 14th, you would then move your 2-bar trailing stop to a 1-bar trailing stop. Now, this is exactly the same stop loss protocols that we use for continuation trades, because what we're saying is we think this has become a continuation trade and we can get more out of it. So you'll have only half your position. Remember, you've taken off half your position and locked in some profits there. And as this comes down, it's keep trading your 1-bar trailing stop. Remember, where you see gaps, the stop of the true high of that bar is the close of the previous bar. Down and down, down. Eventually you get stopped out above this little inside bar. Now, on that day, we had a Danielcode blue line buy signal as well. So that told you that probabilities were now that this move is over. This market's gone down. Have a look at a beautiful setup here. Now, this is all in the trade manual, guys. This has been sitting in the Danielcode website for years and years. Those of you who come to tutorial, this is what I show you, but it's there in the Danielcode trade manual. This is just a classic setup in here for a blue line signal. There was a blue line number down there, which is all on your members charts. That's where you find them. And we have the fast stochastic oversold. We have the slow stochastic oversold. And more importantly, we get this divergence. This market is coming down. And at the same time, this is coming down in a hurry. This market has actually already turned and is going up. So this last bar you see was not the maximum momentum bar. In fact, momentum has turned up. That tells you the 3 things. First of all, the Danielcode target recognition, plus the setups in the fast and slow stochastics, plus the setups with the divergence on the momentum, tells you there's a very high probability of a reversal. That's what created the blue line signal, this bar here. So it was posted ready for the next day, and then you got into the trade. You bought the high here. And, excuse me, same thing. If you just traded the Danielcode blue line signal, you got elected in here. This was your first profitable close. You got out on this close. But if you wanted to take a different view of this, you could see that both the stochastics were moving up. There was plenty of room for them to move up. You could have kept this on a 2-bar trailing stop. It didn't get hit here. Up it goes, up it goes. Once you get up here, this is well and truly overbought now. This is our fast stochastic. This is the one we work on. Our stochastic now is at 91%. That's very high. So we would move our stop from a 2-bar trailing stop to a 1-bar trailing stop, and we would have been stopped out on Monday, March the 28th. Okay, so that's how that works. Let's have a look at another chart now. I wanted to show you the oil chart. Okay, this is the chart for oil. Exactly the same thing. We were in this run-up up here. We got a TO3 and a blue line sell signal on this day, March the 8th. That means we sold the low of the bar of the 7th, minus 2 ticks. This is a futures contract, would have been minus 5 ticks as our buffer if it was a Forex contract, and we put our initial stop above the high of this bar. That's just what the trade program told you to do. So you're elected here on this day. It reaches the first target immediately. The protocol there is to take off half your position. It's a small trade, but it keeps you safe. But if you wanted to expand on that, if you want to get more out of these signals, look at the stochastic. Now, the stochastics are not always right, but they are the way to bet, particularly these Danielcode stochastics that have been smoothed. They do a much better job for you. So you had the same thing here. You had the fast stochastic overbought, the slow stochastic overbought. Look at the divergence. This market's making a new high up here. All of this up here, this is all making a new high, pointing up. We go and have a look what's happening on our stochastic, and it's saying, I don't really think so, because it has now created a lower high in there. Okay, you can see that. This high has made the high. This stochastic is actually starting to roll over right there. So even at this point, this was a stochastic failure. It made a new high for the move. I suppose that was all right. The stochastic made a new high for the move. And here's one day after. Now it's made the final high for the move, and the stochastic has not. The stochastic's already turned. So that's our signal to start thinking about getting short. And then we get short with these Danielcode techniques and entries. And look at our stochastic. If you wanted to hold this for a number of days, you are quite entitled to do so. You use the same technique. You use a 2-bar trailing stop all the way down until your stochastic gets oversold, which it does here. It's down to 21. Don't be too pedantic about the 80 and the 20. 2 or 3 points either side of that's fine. I would consider 78, 79 overbought, and 21, 22, 23, all of that tells me this market is now oversold. Just to give us extra courage on this, the market tells us that it's going to reverse, and it does this by doing a key reversal bar at known Danielcode support, which is the 62.5% retracement. This is the alternative to the 59.3. Markets nearly always use 59.3. If there's serious trading going on, they'll use 59.3. If there's not much, the floor traders will park it at the 62.5 or the 50. And 62.5 is a Danielcode number also. That's the alternate to 59.3. And when floor traders are running the shop, as they were in this case, they will use those numbers because they are taught to use Fibonacci numbers. And 62.5 is very close to the Fibonacci number of 61.8. However, you'll see if you stick your cursor on here that the low for this move was 97.02. The Danielcode 62.5 was at 97.01. So the fib numbers these guys like to use are approximations. The Danielcode numbers are exact. So we have a key reversal bar at known support. Look where our stochastics are. Both oversold. Again, same thing. We've got divergence on our momentum indicator. This is now starting to move up. Here's our low. It's already turned, and the momentum indicator agrees with that. Same thing. If you bought that, you could have exited first profitable close. That would have been a 3. And then as you move along through here, you've got quite entitled to hold this trade as long as you follow these protocols. You get through this day, you're now at 81%. So you now tighten up to a 1-bar stop, and you're stopped out just under this bar, and it's a very nice trade. The next one I had to show you was the S&P, which I think I've already done. Yep, we looked at that. The next one is the US dollar index. Let's find him. And DX. Okay. All of these signals and trades have to be seen in context. If we take a larger view of what's happening here, this is a market that has been trending down hard for a long time. The simplest way we can prove that is we can simply put a regression channel on it. and that tells us that this market is trending down. If the regression channel is pointing down, the trend is down, and vice versa. And that's a very handy tool. It's up here. It's called Regression Line Channel Best Fit inside the Trade Navigator suite of indicators. So we know the trend is down here, and we know it's hard down. So what we got here actually is on this day here, March the 21st, we had a blue line buy signal. To achieve that, it means that the market had to have recognized the Danielcode blue line, which it did on the close, as I recall. Remember, we can see these signals on the daily high-low bars or on the close. Both are valid. Look at our picture down below. It's much the same. Stochastics oversold on the fast time period, very oversold on the slow time period, and you're starting to get divergence on the momentum indicator, because the momentum indicator is showing you that bar's the low. So what we have here, we have a market that's made a new low for the move, and the stochastic has failed, the momentum indicator rather, has not. So that is divergence. That is showing you there is something wrong with this move. There is not sufficient volume or energy in this bar of March the 22nd to continue this market's flight down. And that's why we got our buy signal. So if we have the buy signal, it tells us in the trade program where to buy it. The high of this now becomes a setup bar. Remember, these signals are valid for 3 days. It's the blue line signal. We try to buy Monday's high, we don't get filled. We try to buy Tuesday's high, we don't get filled. We now buy Wednesday's high, we're filled and we're long. And this is a futures contract, so the high of this was 75.81. We're a buyer at 75.83. Off it goes, and our stop loss is underneath this swing here. And this is because this is a blue line, this is an aggressive trade, we want to use aggressive stops. So as this market moves away here, in here's our first target, we take off half our position, we move our stop loss to break even. That's the Danielcode basic protocol. But you can get a lot more out of these trades. This is a decent move away. We've had a strong buy signal. Look where the stochastic is. It's all the way down here. Now, we know that it's going to move until it gets somewhere up near the overbought position. Now, markets don't do this all the time. Here's an example. This trend down was so strong. We got a low on the slow stochastic. We got enough of a rally to lift it off the oversold, and then it went straight back. But that's the way to bet. This market is so oversold that you're quite entitled, if you wanted to hold on to this trade for a few more days. If you did, this was a nasty trade, and this came exactly down far enough to wipe out all the stops if you've moved your stops. So if you're going to hold it, then you have to use the 2-bar trailing stop technique. So when this bar's finished, the stop's under the previous bar, etc., and off it goes. By the time you get up here, you're still on your 2-bar trailing stop, and that means that the stop loss is underneath this bar. Today we've got an outside bar that didn't really go anywhere, but now the lowest low of the last 2 bars is the one on Tuesday. We have Tuesday and Monday as our last 2 bars, so our stop loss, if we were holding this trade, was underneath here. Now we'll see at this stage the stochastic has now got overbought, so we really want to use a 1-bar trailing stop from now on and invite this market to close us out. So there are some examples of how you use these. See if I can find you something else of interest. You asked also about the stop and reverse. Folks are always anxious to know what are the Danielcode failures, and we do have them. In fact, 14% of our trades are failures, and they come in this form. Failures are nearly always the outside bars. So we had here a little sell signal for Monday. It was a reversal bar, so we were very aggressive. We got out at the close. We made about 2 or 3 points. That was all. If you continued to hold that trade, look what happened. It went down and it turned around and it gave you an outside bar. Now, the thing about outside bars, is that in Forex in particular they are directional signals, and in futures they can be directional signals or they can be terminal signals, but the protocols is when you get an outside bar, it means you are wrong, and you must correct by going with the trade. So up in here, if you had, just to show you an example, if we had been buying this high, which we wouldn't, we don't like buying highs, we're trying to sell the highs, but let's say we did, this market continued up and it then turned around, and at the point it took out this low of February the 28th, it created an outside bar. If you have your chart set up properly, those bars will appear to be grey at the time that they're formed, and your inside bars will be red at the time they are formed. So we have to always stop and reverse and take the outside bar trade, and this is a loss mitigation strategy. It doesn't per se make money, but it will get you back your money or some part of it most of the time. Now and again we'll have a double failure, that we'll have an outside bar that fills you on the high side, fills you on the low side, and then goes back and closes in the middle, and that's just one of the horrors of trading, but they don't happen very often. In most cases of outside bars, if you did get short here, there's no reason why you should have, but if you did, and you have an outside bar, you now have to close that, hold that trade until you get your first profitable close. So in that way, we limit our losses. It's a loss mitigation strategy. Okay, they're the main things I have for you today. Let's see if there are any questions. Go ahead and ask your questions now. Kurt wants us to analyze the USDJPY chart for us. Let's have a look at that. USDJPY. Okay, Kurt, what we have here is a very controlled artificial market. Let's start by looking at this thing in a longer time frame. So let's start with it as a 6-day chart. That's where you should. That's where I start my analysis anyway. And now we get a perspective of what this market's been doing. We've now got the high back in 2008, and this market is just on a one-way trip all the way down. And it's very interesting you ask this, because one of the interesting questions is that this currency, the US dollar, and its relationship with the yen is very, very important for huge mercantile interest. America is, by far the largest importer of Japanese goods, and this relationship is crucial to the Japanese exporters. So they have tried continually to weaken this market, and that means this is the USDJPY. This is in fact the US dollar weakening against the yen, and there are limits at which the Bank of Japan gets very upset and says we don't like this, because every 1 cent difference affects their exporters by something in the order of billions. So this is the nice little rundown that we had when the tsunami and the earthquake hit Japan. As you can see, it's all entirely rational. It went down to the bottom of the regression channel. Those of you who look at Danielcode charts will see it went exactly to a Danielcode number. We actually traded this, which was very nice. Let's go back to our daily, and we got short in here. Right on this day, we had a TO3 sell signal. It was the only signal for the day to sell that and get short in there. Same thing with your stochastic. Danielcode protocols, which are designed to be simple, defensive for people who just want to have the set rules and are learning as they go, you got out at the close of that bar. But for those of you who knew more, perhaps have been trading longer, doing tutorials, you could see that on the fast stochastic there was considerable further room for this market to move down, which it did. Now and again you're going to get into one of these great big super moves. They're always news driven, and what happens is don't be seduced by them. All of these markets have an average daily range, and once the average daily range gets past 150%, that market is very likely going to come back on you. So if you see one of these days and you're trading it, get down to a shorter term chart and start moving your stops down progressively to lock in the profit. What happened here was that the G7 in their wisdom decided that they would intervene with huge amounts of money to push the dollar up, that is to weaken the yen. Now, for the life of me, I don't understand why they do that. I don't understand the purpose of why these other countries would be so anxious to help Japan, because the reason it maintains its huge industrial base is because it keeps an artificially weak yen. And the number, it varies between companies, but basically for this exercise it's somewhere around 80, and that's the level that the Bank of Japan always try to keep the dollar-yen cross above that. Why America, Britain, and other countries would be so interested in helping Japan maintain a patently false currency account is quite beyond me. It's one of the great mysteries of life. So what would you like to know about this, Kurt? It's in its long-term downtrend, and it's very hard for markets to break out of that. It takes a great deal of work. Let's go back to our 6-day chart. You can see that it's got a long way to go before it's going to break out of that. There's nothing that looks like a long-term buy signal on here. My guess is it will probably take out these highs. That's what it tends to do, and then it will start to fail, and it will continue to move down the median of the 6-day chart. So if you want to know what markets are going to be doing in the future, longer term, the highest probability is they will be somewhere around the median of the long-term trend channels, and if you want to know what they're going to do short-term, just follow the Danielcode signals. So we have all of that. What else have we got here? Let's see. We're just dealing with questions now. The blue line between the fast and slow stochastic subcharts. Bruce, I don't understand what you're talking about. Oh, Leslie's got another baby. Okay, Leslie, good on you. Okay. John, can you compare the dollar and index futures to discuss why the index did not make an outside bar today, but the futures did? Yeah, sure, have a look at that. Let's have a look. We've got, I'm going to go back to a daily chart. You can see how nicely these Danielcode numbers control these markets. If you haven't had a look, have a look at the new Danielcode members charts on the DX. Some of them, the weeklies in particular, are just fantastic. It's turned within one tick. Okay, so here's our this is the future. This is the index. Excuse me if I sound vague momentarily, folks. I'm trying to juggle technology and press buttons on this GoToWebinar thing and make sure that you can see my screen and everything else all at the same time. So it's a fairly interesting trade here. Okay, so here was our buy signal back in here. We bought this. We got that trade up there. We had one day down. I gave you another buy signal of 3.3. We bought this and got out there. We had pretty nice trading in this market. So what happened today? The question is, this market made a lower day whilst the that's the index, whilst the futures made an outside day. And we saw this chart earlier. So the question is, why did it do it? And the answer is that the people who were trading it weren't following the index closely enough, and obviously there was some lack of understanding on the behalf of traders. But these markets are controlled firstly by genuine trading volume, and secondly by people who are called arbitrageurs. And what they do is they trade and they make their money where they see a difference between markets that shouldn't be there. So in this case, the index did not make a new high for the day, but the futures contract did. Now, the minute the arbitrageurs saw that, and they're doing this on computer-driven programs, it happens too fast for people like you and me to be aware of it, but people like me anyway, I'm pretty slow. But the minute this market took out the high, the arbitrageurs would have seen the discrepancy, and then they would have sold the DX down until it matched the index. That's how they make their money. It's just a mechanical function. They do that thousands and thousands of times for very small amounts. That's what keeps the relationship between the futures and the index intact. And that's the prime reason why markets are wacky when they trade on holidays, because the arbitrageurs, who are the policemen, if you like, who are keeping the market in its set premium or discount to the index, they're not there on those days. So then on those days, floor traders can do pretty well what they like. Let's see who's the next question here. So there's no real reason for it, but that's there's no real reason for it. Would and what is this telling us? Would one go long with the trend up? Yeah, you could. Let me tell you why I didn't. Danielcode didn't create a signal today, because this is undoubtedly a fast trending market, which means that the counter trends are going to be 1 to 3 days. 1, 2, 3. Okay, that's the high. You may not be able to see that, but you will if you turn it into a close-only chart, which means that that market has done the standard correction that it would do in a fast market. If you look at the if you looked at the 6-day chart that I showed you a bit earlier, you wouldn't be going long for a long-term trade at the moment. This market is in a downtrend, and it would have to do quite a bit of base building before it would be able to break out to the upside of the 6-day trend, trend channel. If DC line is precise and known to be reached by markets, why not just place a pending order in advance and wait? Why use stops? Okay, we've had this issue before, and it's very precise. We know that the markets will turn at one of these numbers, but we don't know which one. So part of this stuff is amazing and marvelous, and that's the blue lines and the red lines, and the division of these markets into fractals. But then after that, we have to then go to the man side of the equation, which means we have to use the tools available to us to determine which line will stop the market, and it can be one of many. We then use the idea of probabilities, as I've shown you today. When you get down, there's a blue line right at this number here. But at this stage where you've got stochastics oversold, divergence on the momentum indicators, that now becomes a strong probability that the market is going to reverse. But you'll notice that in everything we do, we want to see the market confirm that we're right. So we have this view of the market. It's set up perfectly for a blue line reversal. We then need the market to confirm to us that we're right, and the way it does that, it actually is price, and it will trade above the setup bar to pull us into the trade. Now, that's terribly important. I actually had a client who came in and didn't realize that and said, oh, wow, this is so fantastic. You know, you just put a sell order in and it gets hit and turns around. It doesn't do that. That's not how it works. And if you just take the time to read the trading manual or look at any of my videos, you'll see that we still need to qualify these trades. Step one is target recognition. It's one of the blue lines or one of the red lines, but then we need the other things set up as well, because this market is hitting these numbers all the time, and it doesn't turn them. And what you get is a vibration because the markets recognize that number. But you absolutely must have these trading situations in line so that we then ask the market to confirm what we think is the situation, and if we are right, it will trade above the setup bar to give us the reversal. How relevant are the bars using a 240 MA or 720 minute for stop loss trails once in a trade? Pretty good. It just depends how risk averse you are. I think that's Akshay. 720 in particular is very, very good on gold and the Forex charts. Try looking at COMEX gold and silver on a 720-minute chart, because you get the division, you get the breakup between what the Europeans think of the market and the Americans think of the market, and you get that tension between the two market sessions. Excuse me, and that's very good. If you're going to be using those sorts of bars for your trailing stops, do not count inside bars. Just ignore inside bars. Once you get down to 240 in particular, inside bars, which will be coming up red on your charts if you have them set up with a Danielcode library, can be meaningful falls or lack of momentum, but more often they're simply periods of indecision. There's not enough volume to create a true bar. So yes, that's a valid technique, but don't count the inside bars. How long have I been trading? About one form or another, about 25 years. How do you see the upcoming time terms in S&P and crude from the long-term trend charts unfolding? I don't think I really know. I haven't updated them for a while. Let's see what we can see here. S&P. Okay, here's our S&P chart. We've got this 59 here didn't work. It's more likely we had an earlier one that came off this. There were two structures here, these two high bars and these two high bars. I chose this one here, but the turn actually came off that one there. So always look at price action to confirm these things. We looked what did they went down to a 62, which is our support cycle, and back it goes. So the next probability in the S&Ps is it's got to recover this median channel, and it hasn't yet. So we'll need to see it continue to do that. But that's what it's trying to do. Let me just make this a bit bigger for you. There's the 62. There's the last 62. That's traditionally been supporting this market. This market is trying to get back into the main channel, which would be above 1329 or so, and then faces another 59 period cycle on June the 6th, and I think that's the next cycle of any significance. I'll upgrade those today, folks. I do all day Sunday and Monday. I do the members charts. I do all these charts by hand, and I do them myself, and I have about 100 and 35 charts that need to be done to produce the 80 or 90 that you people see. So Sundays and Mondays are out. Thursdays I do upgrades your Wednesday night to get the updates done. So that doesn't leave me a lot of time during the week, but this is overdue to be upgraded now. So I'll get a new lot of those out. I was pretty interested in this, in what gold is doing. This has been pretty marvelous for us. Let's just have a look at the gold chart. I know a lot of you folks are interested in that. And you can see here, excuse me, this is gold. The number for gold is 44. I did a webinar on this some time ago, saying, you know, you had two highs here. You had the momentum high in here, but then you had the true high here, and that webinar's up on the website. That 44 time cycle forced this thing down. Where did it go? The bottom of the regression channel, ran into a 62, turned around, reversal, and then it tried to rally into its next 59 period, which was February the 25th, plus or minus 1 week. And I'll show you why that happens, just so you understand. Let us say, for example, that we are starting a wave count off from this high here. We have two bars within the high. This bar of February the 18th is not the highest high, but it's the highest closing high. This next bar gives you the highest high, but the bar before gave you the highest closing high. So if we look at this on a close-only basis, you'll see what I mean. That high on a close-only basis came on the February 18th bar. So it is valid to start the wave counts either from a high-low there or the closing high-low. So that's why these things are plus or minus 1 period, because we don't know always whether we've started it from exactly the right spot. So there's the 62. It drove it up. Where did it go? It only went to the median. Now that tells you this market is getting weaker. Look what's happened in the past. When it's gone to the bottom of the regression channel, it goes up. It has a couple of weeks at the median, and then it goes to the upper channel, or in this case through it. And these things, these big cycles, are a bit like roses. Any of you who grow roses, as I do, will know what I mean. The first flush, the first time in the early summer, the late spring, that your roses bloom, they're magnificent. They're full of power. The petals are strong. There's lots of them. And then as you get to the end of the season, which we're doing now, it's autumn. Now what you people would call fall, just starting. Down under here, and the leaves are starting to come down, and the southerly winds are coming in. Yes, the roses are still flowering, but they don't have that energy anymore that they do in their first flush. So you can see here, this was the first flush, lots of strength, huge, unlimited power. The next one was weaker. It went down again, found support at the bottom of the regression channel. Up it went, tested the upper channel, tested it 1, 2, 3, 4 times. Came down to hold the median, couldn't, went down to the lower channel to get support. Now, from there, it's 1, 2, 3, 4, 5, 6, 7. All it's done is test the middle of the median channel. This market is getting weaker at the moment. Now, that's not to say that a new force can't come into it tomorrow and it starts going gangbusters again, but all we can do is look at the evidence in front of us, and right now we would surmise that this market is weaker than it was. Okay, so let's have a look what else you've got for me, guys. How are we going for time? Not too bad. I'll answer as many of your questions as I can today. Today we have to end a little bit earlier. Last time we did a webinar, I had it on at 9 o'clock, so I'd done all my work beforehand, and we went for almost 2 hours. That didn't suit a lot of people, so we're back to this time, which means I have to go in about 12 minutes. How did you get the multiple clocks, Jan? Pretty easy. They're just my kids did it for me. The best ones, the ones you're seeing are not the best ones. These are just simple Google gadgets. The best ones come from a crowd called worldtimeserver.com. And you can put as many clocks as you like on. I have 4, so I have GMT for Forex, which they call UTC or Universal Time. I have the New York time, New Zealand time, Australian time, and Colorado time. So, but the ones you see on here are just not much jam. They're just straight from Google. How about risk analysis per position and per portfolio? Standard beats 2 position, and no more than 4 to 6 for entire. No, that's not right. The rules say that you, Danielcode rules say that you should have 1 or 2% per fully correlated position. And that makes knowledge of the correlations vital, which is what the trade program does for you. Once you've done that, then there's no limit to, there's no 4% limit. If you had 8 fully correlated trades elected, you would have 16% risk. If you had 6 correlated trades elected, you would have 12% risk. Once we have those correlations right, which is why you should be guided by the trade program, there's no overall portfolio limit that I use. And it's really interesting that statistically you would think that, say you're having a run of period where on your account it's telling you roughly to trade 3 or 4 3 and 4 Forex pairs, or 5 or 6, and then you get a day where there's just one market with no correlations, and that number will jump up to 14 or 15 because it's got nothing that's correlated with. The tendency is to say I'm going to smooth that and make them all sort of around that 5 or 6 number, but backtesting, funnily enough, doesn't support that. I would have said that was very prudent and wise, but that is not actually how it works. What works is if you take just exactly what the trade program tells you to do. Mickey, Robin, Jeannie, let's see, last week I have been using Jeannie and seen a lot more than 14% failure rate. I was wondering something to do with just can't read that. Where are you? No, sorry, I can't read that, whatever you're trying to say. One of the things you can't do and attempted to do, of course, is to just look at the last week or 10 days trading. You can't create a meaningful flow of orders in under about 4 or 5 months. So don't get yourself overly concerned with what happens in 1 week, 2 weeks, or even 3 or 4 weeks. Last October we had a dreadful month. Those of you who were trading with us in the trade room, we just had endless outside bars, which I think we had 12 or 14 on one day. It was quite extraordinary, and for that month it was horrible all month, and we had a drawdown of $58 on a $122,000 account. But if you looked at that month only on its own, you would get a completely wrong impression, because in the next 2 weeks the account ran up 17%. So over the 7-month period, it still continued to average at 7.4% per month. So you've got to look at these things over quite a long time. I caution you that Genie will not quite produce the results that the trade room does, and that's because the trade room has some knowledge, which with Dave Hunt, all he knows is what I've taught him, but he's done 3 tutorials. He's a very skilled trader because he's put in all that work. But there are other factors that are not yet in Genie. For example, over the last few weeks, we've known that we've had a problem in continuation trades, which was fixed in that upgrade on Friday. So the continuation trades, I haven't been creating them in Genie because we know that we've had a software problem. So just give that some time. It'll settle down. Neil, what are you on about, Neil? You're worrying about my cigarettes. Yeah, I've got plenty of them, mate. That's all right. Someone wants to ask a question about the CCI. Can you use this approach with all three types of signals: reversals, threes, and continuations. Yes, you can, Chuck, if you're confident with that. You can use the indicators to qualify the sort of trade you want to take. I do caution you that it's wise to try and get your stops to break even as soon as possible. Once you've done that, that's my definition of a winning trade. Okay, so let's see what else we've got here. It's almost 11:30, folks, so let's see what else we've got here. Yes, we use the indicators to qualify trades for alternate stop manually. Yes, that's the answer to that. Can you show the corn or natural gas chart? Sure. We'll have a corn chart here. Here it is. We're going to start covering natural gas, I think. Jerry spoke with me about it yesterday and said that there's quite a lot of interest in natural gas, and more importantly, the volume is good. So we're going to do that. Okay, well, here's your natural gas chart. You can see that it's in the process of breaking out of its channel. Once that happens, we can then go to two channels, yeah, this thing's gone about 3 standard deviations from the mean. That's likely the top. It's gone too far down. It needs to once these markets break out of their channels and give you a sell signal, there was the conditional sell signal. It actually hasn't been confirmed yet because we haven't had a close below that bar, but this is a 6-day chart. This is very slow. It's likely this will go back and retest. Let me show you more clearly. It will try to go back and retest the bottom of that channel, which is a bit hard, and it's got to. If it fails there, then that trend's over, and it's going to do a correction for a while. So that might be the best we've seen of corn for a while. Don't forget that there's a lot of pressure in these markets because they're priced in US dollar, that there's also an inverse movement in relation to the US dollar. So what you're probably seeing here is it's just a price adjustment based on the fact that the US dollar has rallied in this period, which would discount the pricing of wheat. So that happens fairly often. That's pretty straightforward. NFLX. I think that's a stock, mate. I don't do stocks. I do futures and forex. We're going to be doing stocks. Incidentally, we're going to start off running some these longer term charts on individual stocks and groups of stocks. That'll be coming in the next 5 or 6 weeks. Jerry can tell you more about that. Okay. Are there any changeable parameters for the regression channel? Yes, there are, Glenn. Each market has its own vibration, and so they all have different time channels and price channels. If you read the articles masterclass, there's 2 of them under the articles tab at the website. They're pretty heavy. You might have to read them a couple of times. There's masterclass, it's about time, and masterclass time in gold. You will see that each market has its own unique and discrete vibration. And once we know that vibration, the market will stay with that forever. It will from time to time use different numbers from other markets. We often see gold running on 59 vibrations because that's the vibration for the US dollar, with which it is normally inversely correlated. And in the same way, we'll see that 44 gold cycle pop up in the DX for the same reason. So, yes, they do. But if you use 2 as your use the setting 2 for the standard deviation, in your regression channel. That will fit most of them, and when you do a tutorial, I'll tell you more about that. Are the arbitrageurs members of the Bilderborgs? They might. I don't believe all that stuff, Leslie. I think they're just a bunch of old blokes who get together to drink booze. I am not involved in conspiracy theories. I think there's so much evil done in the world that you don't need to worry about conspiracy programs. Just see what's going on now, and you want to see a real conspiracy program. It's why the hell UK, which has got so few pilots now in their austerity measures that they haven't got enough pilots to fly these planes to put in the no-fly zone in Libya, which of course is not a no-fly zone at all. They're attacking the arms and forces of the legitimate government that they've been dealing with for many, many years. So we're going to have all this stuff about we can go and intervene in countries' affairs anytime it suits us. It's hard to say that we're anti-Gaddafi because he's an evil man and a dictator and not a representative ruler. Well, I mean, so are the Saudis, so are the Yemenis, so's all that bloody crowd, so's the King of Jordan. So it's just absolute hypocrisy. The real conspiracy, if you are into those things, is why the American media doesn't have a slightly more intelligent analysis of what actually happens. In fact, no, it's not just American, it's the world over. Are blue lines and TO3 signals considered reversal trades? Yes. What is considered a continuation trade? A continuation trade would be a trade with the trend. So if we looked at this bar here, for example, this is a 6-day chart, but shows the same thing. There's a key reversal bar at known resistance, the upper blue line. That would be a reversal bar. As you see, it doesn't last very long. Any of these ones, there's a buy, there's a buy, there's a buy, there's a buy, there's another buy. All of these ones in the direction of the trend are considered continuations. What have we got here? Any thought on the developed markets versus emerging markets trade? And I haven't really thought about it, but it's interesting. I might know more next time we're here. Okay, anything else here? Right. Okay, folks, I think that's probably all we've got time for today. It's we've been going for an hour and a half, and I've got to get some downloads done and some signals up for you. So thanks for your attendance. Really, really nice to see you here. I hope that's helped, and we'll look forward to seeing you the next time, which will be a fortnight from today. So thank you very much. Have a great evening, and I'll get the signals up just as soon as I can. And I bid you good night.